Okay, good evening. This is Professor Mayer, and this is our chat session for our Unit 4, and we're talking specifically tonight related to earnings per share. This is our first of two chat sessions related to earnings per share. Once we get through this, we will be scheduling a midterm, but essentially what you're going to have related to this session is going to be homework assignments similar to what you've seen in the past. So if you've done fine on those, I think you'll be fine here. The thing with the earnings per share is the calculations are such that we really need to understand sort of what's taking place throughout the year as we are attempting to identify the number of shares. So there's some intricacies. Once you figure out the calculations, it's really not that difficult, but we kind of need to understand sort of what's taking place in relationship to earnings per share as we are basically walking through these calculations. So this session we're actually going to be doing some very specific calculations, and let's just kind of jump into these and see where we are. What we're looking for is we're looking to calculate not only our earnings per share, but also our diluted earnings per share. And in the diluted earnings per share, essentially the concept of it is the fact that what we're looking for in our diluted earnings per share is that if everything, not that it did, but if everything that could be converted actually was converted to stock, how would this actually impact our earnings per share? And what we mean by this is that if in this case we have a bond. Well, a bond converted to stock creates one issue, but if we convert it to stock, then we no longer have the bond expense. So our bond expense is going to go down, therefore our net income is going to go down. So there's going to be two situations that are going to impact the calculation in terms of our diluted earnings per share. So we have this first example here. Van Heusen Company has net income of $100,000 for the year ending December 31st, 2014. The company has 10,000 shares of common stock outstanding at all times during the year. Key point is that we have 10,000 shares outstanding during the complete year. On January 1st, 2014, the company issued 10-year convertible bond with a face value of $200,000. Each $1,000 bond can be converted into 50 shares of common stock. The bond pays an annual interest of 8%. Assume the tax rate is 40%. So when you're walking through this problem, a couple of things to keep in mind is, number one, it's actually going to be an easy problem. It's an easy problem because you notice that the convertible bond occurred at year end. Interest is 8%, tax rate is 40%. Let's look at this. So the calculated basic earnings per share is going to be pretty simple. So the calculated earnings per share is where we have, in the earnings per share formula, is what you see here at the top, is the calculation where we have net income minus preferred stock divided by the weighted average common shares outstanding. So this is the calculation that we're going to be dealing with as we are working through this problem. Net income minus preferred stock dividend divided by the weighted average common shares outstanding. Well, the weighted average common shares outstanding in this case is there is no preferred stock, so the basic earnings per share is just our net income. We did not have any issuance of common stock throughout the period, so our denominator for the basic earnings per share is the 10,000 shares. So net income divided by the 10,000 shares is $10 per share. Now, let's look at this now in terms of diluted. So in our diluted, what do we have? Sorry about that. In this example, the only diluted security is the convertible bond. When we have dilutive securities, we use the if converted method, which assumes that the security is converted to common stock as soon as it's issued, regardless of if or when it actually converts to common stock. Because we assume that the bond has converted to common stock, we have added back any after-tax bond interest expense to net income. We add back the after-tax amount because when the security was still bond, the interest on the bond was deducted from our revenue and then taxed to yield the net income figure. Our numerator for the diluted earnings per share is net income plus the after-tax effect of bond interest expense. So this is the numerator. This is the top number. There was no preferred stock, so we do not deduct any preferred stock dividend. However, we have a non-convertible preferred stock. If we had a non-convertible preferred stock, we would have deducted the dividend from our net income figure and then added back the after-tax effect of the bond expense. We're not talking about preferred stock right now. We're talking about what we have is we have a bond. So the bond is, the interest expense on the bond is $200,000 times 8%, which is $16,000 per year. The tax rate is 40%, so the after-tax rate is 60%. So our after-tax effect is then $16,000 times 60%, which is $9,600. Therefore, our numerator is 10,000 plus 9,000, 100,000 plus $9,600. So our numerator is $109,600. So this is our net income. Now, we look at the denominator. So the denominator is, we currently have 10,000 shares of common stock outstanding. The problem tells us that each bond can be converted into 50 shares of common stock. So to determine the additional shares of common stock is, we have $200,000 divided by 1,000 shares, so it's 200 bonds. 200 bonds times 50 shares is an additional 10,000 shares of stock. Therefore, our denominator, and again the denominator is the bottom number, is 20,000 shares. So it's 10,000 plus 10,000, so it is the common shares of 20,000. So note that we do not have to weigh the additional shares because they were issued on January 1st. So it is assumed that they were converted as of that date. Our diluted earnings per share then is $109,600 divided by 20,000 shares. So again, let's just make sure that we understand this. So in our diluted earnings, we increase net income by the after-tax effect of the bond as if it was no longer there. We then divide this by our numerator, and our numerator is, we have the additional shares associated with the issuance of the additional bond. So we have $109,600 divided by 20,000 shares. Therefore, we have a diluted earnings per share of $5.48. So the next example is convertible bond on the issue date. So what we have is, we have net income for the year ending December 31st, 2014 of $100,000, common shares of 10,000. On April 1st, 2014, the company issued 10-year convertible bond with a face value of $20,000. Each $1,000 bond can be converted to 50 shares of common stock. The bond pays an annual interest rate of 8%, assume the tax rate is 40%. The difference between this problem and the other problem is, in the other problem is that we issued the convertible bonds on January 1st. In this case, we issued the convertible bonds on April 1st. So this is actually going to affect both the numerator and the denominator as we are considering this problem. So let's go through this. So you notice that the basic earnings per share is net income minus preferred stock divided by the weighted average common shares. So we're assuming that there was no conversion. The weighted average common shares is 10,000. Therefore, we have $10 per share. Continuing on here, now what we have is we have the $200,000 for the bond divided by $1,000 for each bond, so we have 200 bonds. So the 200 bonds essentially is multiplied by 50 shares, so it's 10,000 shares. However, keep in mind that we issued these bonds on April 1st as opposed to January 1st. So we're essentially taking 75% of that. So we have the additional element specifically related to this of 7,500 shares. So our denominator is 17,500 shares as opposed to the original 10,000 shares. Now you notice also that the numerator has changed. Well, the numerator has changed because what we're looking at is we're looking at the expense for the bond, which is 8%, but the 8% is not for the complete year. The 8% is for 9 months. So we're looking at the 8% net of taxes as it affects our net income. And hence what we have is the numerator is $107,200 as opposed to the number that we had before, which is $100,950. Let's go back over here. So the other number was $109,600. In this case, what we have is we have $100,720. So let's look at this. So this is the numerator here. So the numerator is, what we're looking at is the bond expense is $200,000 times 8%. But you notice here that we are multiplying this by 9 divided by 12. So what we're saying is 9 out of the 12 months is the only net effect. The after-tax effect is 60%. So 60% times $12,000 is $7,200. Therefore, we add that to the $100,000 and we get $107,200. And then we go to the next slide, which is actually the piece that we were looking at earlier, which has the numerator. And the numerator is we are looking at these 10,000 shares not for the complete year, but only for that 9-month period. So let's continue on to the next illustration. So the next illustration is we have Seahold Company has a net income of $150,000 for the year ending December 31st, 2014. The company has 30,000 shares of common stock outstanding at all times during the year. On January 1st, 2014, the company issued 300,000 shares of 6% convertible preferred stock. Each $100 of preferred stock can be converted into 5 shares of common stock. Assume a tax rate of 40%. So what we have here is we have the 300,000 shares of preferred stock, and this is 6% preferred stock. $100 of the preferred stock can be converted into 5 shares of common stock. So let's look at the transaction here. So what we're looking at is we're looking at net income minus preferred dividends divided by the weighted average of common shares. So we are assuming no conversion. So in this no conversion is we are subtracting the preferred dividends. Now you notice with the preferred dividends that we are not considering any tax effect. And the reason we're not considering any tax effect is because there is no income tax benefit to paying preferred dividend. Paying these dividends is not going to affect our tax rate, but what we're doing is we are subtracting the preferred dividends from our net income and then dividing this by our common shares. The dilutive security in this example is the convertible preferred stock. Because we use the if converted method, we assume that the preferred stock was converted to common stock on January 1st. Also, because we assume that the preferred stock is converted to common, we no longer dilute the preferred stock dividend from net income when determining our numerator figure. Therefore, our numerator in this case is just the net income of $150,000. Let's look at the conversion. So the conversion is $300,000 divided by 100. So this is 3,000 shares of preferred stock. What we're saying is that each preferred stock can be converted into 5 common shares. So 3,000 preferred shares times 5 is 15,000 additional shares. Therefore, what we're assuming is that what we have is the beginning shares, 30,000, plus the 15,000 assumed converted shares. So we have the total shares of 45,000. Therefore, our diluted earnings per share is 150 divided by 45,000, which is $3.33. Let's look at the next example. And the next example is that what we have here is we have Seahorn Company has net income of $150,000 for year-end December 31st. We have 30,000 common shares. On January 1st, the company issued 300,000 preferred stock. Each preferred stock can be converted into 5 shares of common stock. So I'm going to calculate the basic earnings per share and the diluted earnings per share, and this looks a lot like the problem we just had. In this case, we're assuming that on January 1st, common stock issued 300,000. Each $100 of preferred stock can be converted into 5 shares of common stock. Assume a tax rate of 40%. Net income minus the preferred stock, and actually in this case what we have is we actually have what we see here is that the 300,000 times 6% times a half is $9,000. So what we're saying here is that the basic earnings per share is $150,000 minus $9,000 divided by the $30,000. In this case, what we're saying is that we issued the preferred stock on July 1st. And I will tell you again, just to clarify this, is this problem actually had a date wrong, is that we actually issue the preferred stock on July 1st as opposed to January 1st. So the dilutive securities in this example is the convertible preferred stock. Because we use if converted method, we assume that the preferred stock was converted to common stock as soon as it was issued, which in this case was July 1st, 2014. From the problem before, we learned that we no longer deduct preferred stock dividends since the preferred stock is assumed to be converted to common stock. We simply have the $150,000 as the numerator. The denominator is actually going to increase, and it's going to increase to the extent of the weighted average. So what we're saying is that each preferred share is convertible into 5 common shares. So there is 3,000 shares. 3,000 shares times 5 common shares gives us an additional 15,000 shares. However, what we're looking at here is we're only looking at 1/2 year outstanding. So instead of having the additional 15,000 shares, we're only having the additional 7,500 shares. So it's 15,000 times 50%, which is 7,500. Therefore, our denominator is 37,500 shares. And what we have is our diluted earnings per share is $4 per share. So it's $150,000 divided by 37,500 shares. And let me just kind of go back here and just emphasize one point, is that when we're considering diluting or converting bonds, is we need to take into consideration the fact that bonds actually have a tax effect. So the effect in terms of net income for a bond is going to be net of taxes. When we're looking at preferred stock, is there is no tax effect. So we're essentially taking away from net income the preferred stock dividend. We're taking away the preferred stock dividend because the assumption that we have when we're looking at earnings per share, we're looking at earnings per share that become a part of the earnings that are due to common shareholders. Well, what's due to common stock shareholders? The net income minus any preferred dividends. So we want to take out the preferred dividends before we consider what's left over for common stock shareholders. But again, preferred stock dividends have no tax effect. They're paid on after-tax income, so there is no tax effect. Therefore, we are not considering the tax when it comes to the preferred stock. Reamer Company has net income of $150,000. The company has 30,000 common stock outstanding, 30,000 shares of common stock outstanding during the year. On July 1st, the company issued $300,000 worth of 9% convertible preferred stock. Each $100 of preferred stock can be convertible into 2 shares of common stock, assuming a tax rate of 40%. In this case, 300,000 times 9% is $27,000. So $27,000 is the numerator if it was issued on January 1st. In this case, it was issued on July 1st. But again, whoever put these notes together didn't take this into consideration. So what we have is $27,000 here. So the earnings per share is $150 minus $27,000 divided by 30,000. If we were to consider this from the perspective of issuing the stock on July 1st, we would take half of the $27,000 and subtract that from net income, divide that by the outstanding share. In this case, what we're looking at is the dilutive security. In this example is the convertible preferred stock. Because we use if converted, we assume that the preferred stock was converted to stock as soon as it was issued. And in this case, we're looking at January 1st for the issue date. Also, because we assume that the preferred stock is converted to common, we no longer deduct the preferred dividend from net income when determining our numerator figure. Therefore, the numerator in this case is $150,000. So we have $150,000, and the convertible rate is 2 common shares per preferred shares. There are 3,000 preferred shares, therefore the additional shares is 6,000, and what we have is we have 36,000 as our numerator. Because diluted earnings per share is greater than our basic earnings per share, the convertible security is considered to be anti-dilutive. Given that this is the only convertible security reported in this example, we would not report diluted earnings per share for this company. If we had several convertible, potentially dilutive securities, any securities that increase earnings per share would not figure into our diluted earning calculation. We went from 410, we have 417 here, so there was actually an increase of 7 cents per share. So what we're saying is this is considered to be anti-dilutive. In other words, it actually increases the earnings when we use take away the preferred stock. So in this case, what we are considering is the fact that we would not be reporting a diluted earnings per share because of this situation. We want to consider, and you're going to see some problems like this in the homework, is what we have the following transactions during 2014. Consider each of these one by one and consider. So we have 360,000 shares outstanding as of January 1st. On July 1st, we sold 200,000 shares of additional stock. So the additional stock on July 1st is only of value for the 6-month period. Immediately after that, we declared and issued a 50% stock dividend. So the 50% stock dividend is based upon the total shares that we have, which is 502 $60,000. On September 1st, we sold an additional 240,000 shares, and then on October 1st, we purchased 60,000 shares on the open market to be held in treasury stock. Regal has the following securities outstanding throughout the year. So we have a non-convertible cumulative preferred stock 8% $100 par issued at par $200,000. We then have a convertible cumulative preferred stock 6% $100 par issued at 105, convertible into 30,000 shares of common stock. We have paid in capital in excess of par for the preferred stock of 20,000. We have a $1,000 bond, 6% issued at par, convertible into 25,000 shares of common stock, $500,000. Net income for the year was $640,000. The company tax rate is 40%. None of the securities were converted throughout the year. Calculate basic earnings per share. Calculate the diluted earnings per share. You notice this, and I want to kind of go through each of these items. Okay, so we actually have to sort of back into this. So you notice that we had a 50% stock dividend. So the 50% stock dividend actually affected any transactions that occurred prior to the stock dividend. So we have the adjustment for the stock split or the stock dividend, and it's a 1.5, so a 50% dividend. But what we see here is that we have 360,000 shares. 360,000 shares, the weighing period was 12 months. We multiply this by 1.5, and we have 540,000 shares. The next one is when we issued additional shares on July 1st, is these additional shares are only available for the 6-month period. So it's 6 months out of 12. And in this case, we multiply it by 1.5, and this is $150,000. So let's just kind of understand this, is the stock dividend that you see here only affects what occurred prior to the stock dividend. Only affects what occurred prior to the stock dividend. The transactions after the stock dividend is what you see is that on September 1st, there was an additional 240,000 shares that were issued. However, they were issued on September 1st, so their impact from a weighted average perspective is only 4 months out of the 12 months. So 240 times 4 divided by 12 gives us an additional 80,000 shares. And then we bought treasury stock of 60,000, but that was on October 1st. So the impact was for a 3-month period. So the impact here is minus 15,000 shares. Therefore, our weighted average common shares during the period was 755,000 shares. This actually is a very, very good example, and you need to kind of walk through this as you are going through the problems. Okay, and you're going to see some problems like this in the homework. Let's continue on with this and see now what's taking place. So we're looking at the basic earnings per share. Keep in mind that even in the basic earnings per share is that we need to calculate the weighted average. So we did calculate the weighted average. That is the denominator. And now what we want to look at is the numerator. So there are 2 preferred stocks. There is a 8% preferred stock and a 6% preferred stock. These were in place the whole year, so we don't have to worry about conversion of these throughout the year. So I have minus 16, minus 24,000. Therefore, what we have is we have the basic earnings per share of 79 cents. What we want to consider now is the dilution effect. So the dilution effect is related to what we have for the convertible preferred stock and the convertible bond. So the convertible preferred stock, and you notice how we're not doing the complete calculation, we're actually doing these individually, in the sense that what we have is that we have the basic earnings per share of 79 cents, and then we are going to impact this through the conversion of the preferred stock and then through the conversion of the convertible bonds. The idea is that there was only one bond that was convertible. It was convertible into an additional 30,000 shares, and the dividends associated with that preferred stock was $24,000. So $24,000 divided by 30,000 essentially is giving us a dilutive factor for the common preferred stock of 80 cents. And you notice there's no tax effect on these preferred stock. Now let's look at the convertible bonds. So the convertible bonds, you notice it's times 1 minus 40%, so it's 60%. So it's 30,000 times 60% divided by the conversion factor, which is an additional 25,000. Therefore, the bonds have the net effect of 72 cents on the dilutive earnings per share. So what we've got is we've got the impact of two items. These two items are the common or the convertible preferred stock that's convertible into an additional 30,000 shares of common stock, and the convertible bond, which is convertible to an additional 25,000 shares of common stock. Individually, the preferred stock has a 80-cent impact, and the convertible bonds has a 72-cent impact. When we're looking at this, is the diluted earnings per share essentially ends up being 77 cents. So 77 cents is impact of the bond. We still are taking away the first preferred stock, and then on the denominator side is that we have these two additional elements of the preferred stock and the additional item related to the bond. 30,000 shares of preferred stock, 25,000 shares of the common stock. Everybody have a great evening. Thank you very much, and we will talk to you soon. Okay, in 2 weeks. Okay, thanks.